All right, guys, let's go over some Fibonacci levels and we can have a look and see what's happening here. So, first thing we want to identify is that we're in a five wave Elliott wave pattern. So, we've got wave one here, wave two is our pullback, wave three, wave four is a pullback, and then wave five. Now, we've also gone through an ABC correction when we had the tariff crash. So, A, B, C. I've drawn these Fibonacci levels up prior, so let me start adding them back in one by one and we'll have a look at them. Okay, so firstly, we've identified another ABC correction that we've gone through. Then we've identified a internal five wave pattern within the fifth wave that we're in at the moment. Then here we're drawing this Fibonacci level from the high to the low to the high of the ABC correction and showing that the SPY very much agrees that we've gone down close to the 1.618. So next, I want to draw this fib level. Basically, we've drawn here from the low to the high to the low. We've got a 100% measured move area and we've tagged that perfectly. And then you'll notice we've pulled back. The next impulse move, we've gone from the low to the high to the low. We've got another 100% measured move area. And again, we've pulled back. The next one, we've gone from the low to the high to the low. We've hit the 100% measured move area again at 687.71, and we're now pulling back. Now, if we have a look at a little bit too far forward, the long-term Fibonacci levels, so from the COVID low, 21 high to the low, we get a 100% measured move area of 608.85, which brings us right to there, the peak before the pullback and where the tariff crash. So then our next level, low to high to low, gets us the 100% measured move area here before the pullback in April 24. Then the next low to high to low correlates again back to this 100% measured move area for the peak of February 25 before the tariff crash. And then our next low to high to low, this orange one up here, it's getting a bit complicated now, but again, 100% measured move area, 684.08. So we're currently dancing on that 100% measured move area. Now, technically, there is one more because we have to count from the second wave to the top of the third, and that does actually bring us up to 746.92. However, we're not going to reach that. And the reason we're not going to reach that is because we're trading within a parallel channel that has been lasting for the last 5 years since the COVID low. So let's go to a weekly time frame here. Have a look at this one. Here we've got it tagging in March 2020 with the COVID low. Tag the top, tag the bottom, tagged, confirmed, and now we're right at resistance here within it. We keep rejecting. And SPX, people think it's the same, but it's actually a little bit different. This is the actual market, whereas SPY is the ETF. We can see the same parallel channel. So tagged it up here. And again, we have a perfect rejection right there. So that doesn't mean we can't get a euphoric blow off top, but the chances are less likely from a technical point of view. You're not gonna go there. It might, but it's very unlikely. There's a lot of resistance here, and people are respecting the channel. It's very, very unlikely to keep going. Okay, now let's have a look at the cues here. So this pink arrows, I know somebody that incorrectly entered a long position here. So that was just a marking I had there. You know who you are. Let's turn on the trend indicator and our buy and sell signals. Let's have a look what's going on. So firstly, we're within that, well, we're under the parallel channel, the internal parallel channel, which has been for 8 months now. Kept trying to break through it and kept rejecting, and now we're curling over. When we look at our stochastic, 533 is the settings we use on this, and we can see that we're turning down there. We also have a cooling MACD here. Now, that doesn't mean we can't pop off or anything soon, but we will have some signals. Let's go to a 2-hour chart and see what it's showing. So 2 hour is now in a downtrend. You see these clear rejections on that trend line. It looks like it's not going to go much further than this. We'll just have to see what happens. The FOMC meeting's coming up, and that could change things, obviously. But in terms of what the chart's telling us, it's telling us it's going to curl over. Okay, over to the bellwether indicator, and you can see we had this negative divergence here back before the tariff crash. And this is the S&P down the S&P 500 down the bottom here, and you can see here we got the same negative divergence happening again. So been saying for a while that these areas look the same as this, and it's, pretty similar. So we'll have to keep an eye on it. Our MACD is, negative here, so we'll just have to see, how this plays out and what happens. Okay, over to gold. We are starting to base out here, and it looks like we're going to get set to pull up soon. So that'll be right in line with the FOMC if it does, and we'll see how that goes. But we're looking like we're more than likely going to be sideways to up here. Potentially we tag that lower level of resistance and then we go, but it's looking like a pretty good bullish setup, and silver obviously taking off today as well. Let's have a look at silver. It's still going up now. It's doing really, really well. So gold is more than likely going to follow soon. All right, coming over to the market breadth chart that we have here, we can see that breadth is starting to drop. We've got 51.3% of stocks now above their 20-day moving average, which is not looking good. We're trending downwards. What I'd also like to point out to you on this particular indicator is we have here these pinkish red shaded areas. So that is when the market goes 12.5% plus above the 200-day moving average on a daily time frame. So you can see there we went to 13.36, 13.41, and what was that one there? 12.53. And these typically put in market tops. So you can see these ones here as well. We're marking market tops over here, getting 14.97%, and then these market tops over here we're marking 14%. So those areas typically mark the market tops. So again, over here, 12.67. So 12.5% is typically the area where we get the warning, and then we go from there. That is on the daily time frame. If we go over to SMH and we have a look on the weekly time frame, these are when we get above 100% from the 200-day moving average. So we see we're 100.87% here. Again, typically marking market tops. So 101, 109, above those areas, always marking market tops pretty accurately. Very good indication to know what's going on. So guys who use my indicators are also using this particular chart to have a look at market breadth and see what's happening on the weekly time frame. Also able to catch market bottom. So if you have a look here, we have some rules for catching a bottom. So, 2 to 3 weekly red candles in a row, followed by 1 weekly green candle. Market breadth drops below 15 and then back above 15, indicating that the bottom is in. And you can see that repeat pretty much every time. So back here, COVID low, every single time we have a crash, we can know when it's safe to jump back in. Combined with the market breadth chart, we're also obviously using the trend indicator as well as the buy and sell signals. So you can see here, when we got that market bottom, we got the buy signal as well as the trend change signal to jump back in. So that's obviously also giving us that indication. And if we go all the way back to the COVID crash, if you want to see that one as well, we've always also had the upsell trigger, the uptrend trigger, as well as we actually had a really strong buy signal here. Market obviously still went down, but there would have been a decent shift here. Yeah, we had some bullish divergences. Again, good to wait on the bottom of the crash, so ignore the buy signal. Market did shift at that point. You can see here the RSI really picked up. We're talking, let's make sure we get this right, 13th of March. So here, we had a definitive shift in market participation there. So, and we also had, quite a good bullish divergence. So it picked it up. The signal picked it up. Doesn't mean the market wasn't still selling off, but obviously combined, we use the breadth indicator as well as the trend, as well as the buy signals, and then we know what's happening with the market, and we know we can jump back in right here, and we're on the road to recovery at that point. So that is how we find some market bottoms and when it's safe to enter. You got to always remember it's fine to be 5 minutes late. You don't want to buy at the bottom. Congratulations if you did, but you took a lot of risk. Getting back in here was safe to do so. Okay, up top here we have the VIX on a 2-hour time frame. Down the bottom here we have the S&P. It's actually not looking too bad. It looks like we might start to, continue along here and potentially flow down soon. So not looking too bad. MACD is still positive here, but more than likely starting to cool off and can go down there. We just have to see how the FOMC turns out. They could have it already priced in and then we'll go down. If they don't have it priced in for the cut, then, we'll go up. We'll just have to see how the charts play it out and then we'll have to play accordingly. All right. Thanks, guys. Bye.